Hey there, everyone. Welcome to Chart This with Dave Keller. It's Thursday, May 15th, and welcome to the show. We're coming to you from a beautifully overcast, a little bit wet, but not too bad, Redmond, Washington. Thanks so much for joining me wherever you're at. Got a little time zone update in the YouTube chat with the daylight savings time affecting the difference between the U.S. time zones and European time zones. That just hit me. I had a call with someone in Dubai and completely screwed that one up because of the time change. It's fluid, right? It's a fluid time zone sort of relationship. The iPhone app that shows you world time zones, my greatest friend, as I've done more and more stuff globally over the years. And I encourage you to find a good website that can help you summarize time zone relationships anytime you can. Interesting day in the markets, a weaker open, higher close, not a huge directional move, but flipping the script from what we've seen in recent days, where you actually see technology, consumer communications, the three FANG sectors, which were positive yesterday, actually at the bottom of the list. Today, at the top of the list, you've got defensive sectors like utilities, staples, REITs, even healthcare, fourth from the top of the list. So one day only, but will be interesting to see how things play out through the remainder of the week. We've kind of gotten through the big inflation data of the week with no significant drawdown for the S&P and the NASDAQ. So at this point, we'll remain sort of on a pedestal of sorts, sitting up after a pretty decent 20+% rally off of the April lows. Today's show, we're going to update you on what happened with the markets. We'll look at the market carpet and focus on some individual names on the move. I've grabbed a couple charts at the end to share with you as well. We'll take a couple questions. We'll call it a day. Let's get to the charts and let's see how things played out. As I mentioned, the S&P higher today, 59.17 or so is where we'll call the close. We got up to almost 59.25 earlier in the day. Sort of a choppy afternoon, to be honest with you. The big move was from around 10:30 Eastern to 1:15, 1:30 Eastern. From there, sort of chopping around, waiting and seeing. That puts the S&P up 0.4% from Wednesday's close. The Dow leading the way higher. The Dow's been lagging the S&P and the NASDAQ for a little while now, but actually finishing higher, 0.7%. The NASDAQ demonstrating that it can actually go down on one of these days, down 0.2%. Mid caps and small caps all up, and the S&P S&P small cap, that is, index up the most, still only about 0.6%. The VIX drifted lower, so while the indexes were mixed, volatility remains lightening up. And again, in this sort of environment, I mean, I think regardless of what you think about the direction of the markets going forward, whether you think this has been a huge counter trend rally and the next big leg lower is coming any day now, or whether you think that's crazy and you think the market's going higher from here, I think with low volatility, I mean, it basically just means that a big down move is certainly not happening at this moment. And watching for the VIX to pop above 20 usually tells you, okay, this could be something more significant. So once you sort of define that primary trend, sort of defined where you think the primary action is, I think you always look for signs that something may be different, something may be changing. And there are a couple of things that we've talked about. We'll reiterate today. VIX popping above 20 would be a big sign for sure. Not happening today. Volatility remaining fairly low, even as some of the growth sectors pull back a bit today. Meta, by the way, one of the more interesting charts, arguably an evening star candle pattern. We grabbed that chart to talk about a little later in the show today. Bonds moving higher today. The TLT up 0.9%. Rates actually moving down. Again, this is against the prevailing winds we've been seeing here. From mid-April now to mid-May, it's been stronger stocks, stronger dollar really at the end, weaker bonds, and commodities pulling back. Certainly gold prices pulling back. But today you're seeing bonds pop back up. You saw gold move higher today. We saw the dollar move lower. We saw stocks, particularly growth stocks, moving lower. Some area of the equity markets did just fine today. So today, bit of a mean reversion, bit of an opposite move to what we've observed. Not a huge, big, concerning change, but certainly something to pay attention to. The long bond yield, by the way, ticked all the way up right to 5%, but then came off. Finished today around 4.92. The 10-year yield's around 4.45. The 5-year point still above 4%, not by much, 4.07% is what I meant, almost below 4% there. Bond prices moving higher in the form of the TLT, which finished up about 0.9%. The dollar slightly lower from where we were yesterday. Looking at the commodity space, gold and silver moving higher. I feel like the declarations of the death of gold were greatly exaggerated, or whatever that quote is that I just paraphrased. The GLD up 1.6% today, silver up, copper up. The energy side of the commodity space pretty red here. So crude oil prices, natural gas prices, all to the downside. I mean, to be clear, the chart of gold is still not a bad chart. I mean, and arguably still a very good chart, right? We're still above an upward sloping 50-day moving average. We're holding it today. Just breaking below the previous swing low, sort of like an initial warning sign. But we'll see. We'll see. I mean, if the 50-day holds, it's not that bad. 50-day starts to break, we have to rethink whether the primary trend is starting to change a little bit. Our market trend model, as of last Friday, still bullish. We'll see what happens after tomorrow's close. Crude oil, we're seeing some weakness here. Energy, again, I feel like anytime energy starts to look interesting, crude oil prices sweep in with a big down day to eliminate all that optimism you might be feeling about energy stocks. Looking at cryptocurrencies, pretty much all in the red here. Bitcoin's actually had a pretty choppy 24-hour period. You can see Bitcoin's currently trading just above 103,000. Ether prices right around 25.30. Those are both down from yesterday's close. All right, looking at the 11 S&P sectors here, we've got defensive sectors at the top of the list. Utilities, consumer staples, both up over 2%. Coming out of the April low, defensive sectors have been underperforming the S&P and have certainly been underperforming, sectors like technology, which have been much stronger. Tech, the XLK is probably up around 30% off the April low, compared to the S&P up about 22%. So definitely outperforming on the way up. And utilities and other defensive sectors up, but up a lot less than that for sure. But today, you're seeing a resurgence into some of the defensive sectors. Again, this is one of the things that we talk about, right? One of those warning signs. When you have this big move higher, where a lot of people are really starting to believe, and I've definitely felt that around with comments on the show, with comments on social media, you look for signs that that's evaporating. And I think that comes from price action, right? The S&P below 5750, I think, becomes a very different chart. It comes from breadth conditions, which we'll talk about here with one example. But, stocks starting to break some key levels, distribution shown in the form of deteriorating breadth indicators, and defensive sectors really starting to outperform, showing that, really big investors are rotating to defensive positionings. And we've not seen any of those kind of danger signs just yet. For now, it's still looking like a pretty good rally off of the lows. On the downside, only the XLY, only consumer discretionary in the red today, down 0.2%. We can see technology, communication services. Those are your three sort of growth sectors at the bottom of the list today. And again, flipping the script from what we had yesterday, which was growth offense at the top and defense down at the bottom. So one day only, but we'll continue to track that certainly tomorrow and into next week. See, that's the beginning of something further. Looking at the breadth data here, pretty good breadth if you're looking at the S&P, pretty okay breadth if you're looking at the NASDAQ composite, and then kind of everything in between. So right in the middle, this is the advancers decliners for the S&P 500. We can see 75% up, 25% down, so about a 3-to-1 ratio up versus down. The NASDAQ composite almost more balanced, 53% up, 44% down. So the growthier areas of the market, weaker breadth, overall still pretty good to very good today in terms of one-day breadth conditions. Looking at the Magnificent Seven and friends here, we've got Netflix pushing to the upside. Netflix is one of the few of this basket of names actually making new all-time highs in the month of May 2025, up another 2.3% today. Microsoft and Broadcom, two stocks that have rallied pretty good, and we have those steep trend lines on both of those charts we've tracked here. I didn't grab them today to share with you, but we've been highlighting those, still remaining above the trend line support. They're both up about 0.25% today. On the downside, Amazon and Meta, your two worst performer, both down over 2%. Tesla, which has been pretty impressive, rallying above the 200-day moving average, pulling back a little bit as well. And that chart of Meta will highlight here in a few moments. All right, let's look to the market carpet. This is a heat map style visualization. As I bring this up as a reminder, I can see questions and comments on all the platforms upon which we're streaming: Facebook, LinkedIn, YouTube, and X. I appreciate you guys tuning in live. Those of you that are doing so, you're welcome to ask questions as we go. I'll get to a question or two before we wrap the show. We're planning an all mailbag episode tomorrow on Friday, May 16th, and we'd love to answer one of your questions on the air. So drop them here as we go, and we'll grab a question or two at the end. Looking at the market carpet again, my goal with market misbehavior, pretty much all of the work that I do, is less to tell you what I think is going to happen or tell you to listen to me and make these trades. Not my game. My game is to help you make better decisions and help you improve your process, help you improve your situational awareness for the markets, all those kind of things. I want to empower you to be a better investor, not tell you how to do it day in, day out. So I would ask you, looking at this market carpet, what stands out to you? If you've been watching the show for a while, this is how we usually approach it. I literally bring it up. I do it a couple times a day. I just kind of stop and just look around and just think about it and jot down tickers or jot down themes, jot down just general things that I'm observing. I don't know about you, but as I start from the upper left, kind of an underwhelming day for technology. And that's been sort of contrary to what we've seen a lot of days here in, from mid-April to mid-May, which is resurgence in growth, resurgent strength in a lot of those leading growth names, but a lot of other names in technology, software, hardware, services kind of names. Today, you're not seeing that, right? You're seeing the biggest names essentially choppy flat today. You're seeing some random things up like Cisco, which had a pretty good pop this week, I believe, on earnings. You have IBM up over 3% today. You also have some things down like Empower, which is one of the semiconductor names. AMD also in the semiconductor space moving to the downside. In the middle, kind of have a trifecta of down names: Amazon, Tesla, Meta, three stocks that have certainly been some of the better examples of breakouts above the 200-day, trying to hold those breakouts above key moving average support. Those are pulling back today. Healthcare, a lot greener than we've seen in quite a while. This is a sector that has been bright red with Eli Lilly, Johnny John, all the other pharmaceutical names getting absolutely clobbered. Today are getting a nice bounce higher in a lot of those names. Now, again, the chart of Eli Lilly is not a particularly strong chart at this moment. 2.5% up day does not much to erase a decline from 900 down to almost 700 in the month of May, which is what's happened. So we got a long way to go, but again, something to watch. And what's interesting about the chart of Eli Lilly, to be honest with you, and I'll jump there real quickly here. What's interesting about a chart like this is the fact that we're at this pretty well established support level, right? So this is a stock that's been beaten down for so long, but look at here we're at, kind of back around the range where we've had a lot of previous lows, sort of in that 700, 720 range. Most major lows in the last year and a half have all been right around this price point. So what happens when a sector becomes beaten down and starts to sell off so aggressively is you quickly come to those previous lows, right? If you look at the chart and look to the left, it's reasonable to expect at least some sort of bounce there. So if I'm more of a swing trader, I'm looking for those tests of key support levels as an opportunity to play more on the upside. As at least as a trade, I think there's a lot more that would need to happen on that chart to look more like an investment, more like a broader recovery. But in terms of a corrective move or a reversal of the prevailing trend as we test support, makes a lot of sense to me. United Healthcare, of course, the big outlier today with some pretty negative news coming out. Stocks down over 11% today. They've had obviously a lot of issues, and the chart sort of shows that. One of my analysts at Fidelity, Mark Dibble, he had a great chart he would show in presentations, and I forget what the stock was. I don't know if that'll come back to me. I'll have to ask him. But he had this great chart where he had a whole page, a slide where it was, here's a way that a fundamental analyst figures out that there's fraud. And it was like all along the way, all these different things. And then this earnings were restated here. And then the news came out about the company management. Then they had to change their board. Then they fired the CEO. And then these other things. It's like all these And it was how a technical analyst identifies fraud. And it was like this big line and the price just went below it. And it was just like done. One check, it's done. The chart's breaking down. Something's up. I need to get out of the way. And the chart of United Healthcare reminds me of that great example he used to show. As sort of a flip the script example within communication services, you have the two biggest names, Alphabet and Meta, down today. Netflix up, and Netflix is sort of in that same vein. one of the few Mag 7 stocks, really the only one making a new all-time high today, of course. But you also have AT&T and Verizon, which are two of the old school telecom names that have been chopping around here since the April market low. These were stocks that actually rallied pretty good in Q1. Both of them have sort of been chopping around. They really haven't broken down a ton. They've been more sort of holding water. And what the chart of like AT&T or Verizon reminds me is that, prices can correct in one of two ways. They can correct in terms of price or in terms of time, right? They can, in correction in price is we literally draw down and the price had been going up and now it stopped, it starts going lower. But a time correction is more of just a sideways period as investors digest the previous gains. It's more of an equilibrium. It's a pause button. And then hopefully the trend resumes. And I think the way you validate that is breaking above trend lines, so drawing trend lines off the previous highs, looking for breaks there, breaking above previous swing highs, getting above previous levels of resistance. Those are all things I would be looking for. All right, let's look at some charts. We'll take some questions. We'll be done. Here's the daily chart of the S&P 500. Continues to go higher, as we've been talking about, right? The tactical trend in the S&P undeniably stronger. We picked that up in the month of April as we saw those initial accelerations off of the low, and the short-term market trend model that I manage, is meant to pick that up. What's not turned for me on the S&P as of last Friday, and most likely turns this Friday, barring some huge sell-off tomorrow, would be the medium-term trend, and that's the main one that I use for risk on and risk off. So the V-shaped bottom really, accelerating the decline, but also accelerating the rally off of the lows. Now we're left to evaluate the conditions today. I mean, again, when I'm looking at any chart, I think of it as guilty until proven innocent, which is, I think, where the S&P has been for much of 2025, and then innocent until proven guilty, right? It's all about what you assume the primary trend is, and then evidence you're looking for to tell you that that's no longer the case. I think given the breakout above the 200-day, I think you have to consider the S&P in a primary uptrend. And what would tell you that's different? I think breaking that 200-day moving average, filling this gap that we've talked about, would be pretty significant. If you ask me to guess what actually happens here, I mean, who knows? Given the uncertainty that we have right about now, I wouldn't be surprised if we get some sort of rollover back into the support range. Everyone's going to feel validated. Bears will wake back up and think, all right, this is just the beginning of the big down move. Bulls will be empowered by a pullback and an opportunity to buy weakness, and that will be the grudge match as to which side takes control. And I think holding that 200-day could be pretty valuable. I'm not the only one, of course, focusing in on that key level. Shout out to one of my Market Misbehavior Premium members, and if you like what we're doing here, we have a premium membership. Hopefully, it pays for itself many times over in how much it improves your decision making and your management of risk and upside potential in your portfolios. But we have a community, a members-only community, where we exchange charts, where I get a lot of questions. That's where I answer every question that comes in. Really good opportunity to support a smaller group of investors trying to up their game using technical and behavioral techniques. And one of them posted this. He said, look, the rally has been impressive, but I can't help but notice we had talked, and in my work, we talked a lot about at the beginning of 2025, comparing that to 2022. And we had come about that from the fact that late 21, the fourth quarter of 2021 and the beginning of 2025 looked very similar in terms of the divergences. So many things lined up. I mean, it almost looked exactly. And so it was, all right, we could have a 2022 kind of year. And certainly we had that sort of vibe in February and March. Now we've had a significant rally. We're currently about 3.6% down from the all-time high in February. And if you look back at 2022 and take the peak from the high in January, and then go to what ended up being the secondary peak before the big move lower, it was almost exactly the same amount, 3.6% lower. So again, I don't know if that is how I would design a trading system, to say, hey, here's what's happening now, and here's what happened this one other time. So it's probably going to be the same. But the comparison is striking to me. A lot of similarities in terms of breaking back above the 200-day, getting to about the same point. Now, what sort of showed you that this was going to get a lot worse. From a technical perspective, I would say a number of things. And I would say volatility increased, breadth deteriorated, defensive sector started to work, all those things we talked about earlier. But on the chart of the S&P 500, this is why I think the 200-day moving average is so important, because the bull case, we don't break the 200-day again, right? We continue to push higher, and this is at the beginning of retesting the peak. We stall out about here, and then we fail to hold the 200-day. That was sort of the beginning of a real negative period there. So again, I'm not seeing that play out yet, but that's sort of the script that I have in the back of my mind that I would be looking for. And if we would see that, we'll let you know for sure. But as of right now, it's, if you have a UR here, marker from 2022, or kind of right at the end of March, and then again, conditions started to deteriorate, and I think you had time to recognize that if you followed the information along the way, which hopefully we'll try to help you do here on the show. The McClellan oscillator still remains above zero. And again, when I talk about breadth deteriorating, it's things like this, right? The McClellan oscillator has been above zero really since the third week in April. That was one of the many things suggesting a very strong tape out of the lows. Looking back, these are signs that I feel like, boy, now seem incredibly clear that we had crazy strong breadth. That's good until it isn't, right? And I think if you look back at previous times where the breadth has been so strong, when it rotates lower, that's where you have a potential to rotate in a bigger way. The volume overall is still pretty supportive. So as long as we have signs of accumulation in terms of stronger volume, as long as we have breadth remaining strong, telling us it's a broad advance, those are the things that suggest we're still in good shape. Those things change. That's when we start to get concerned. I've had plenty of questions about the chart of gold on yesterday's show, given the pullback that we've seen. Again, my market trend model is still bullish on gold, and I will tell you the reason why. Sort of look at this, right? We're at the 50-day moving average this week. We've pulled back to an ascending 50-day moving average. As long as that holds, it's just not that bad of a chart. That starts to break, I think we start to get more concerned. I have a decent position in gold. So this is something I'm watching very closely. Really haven't made much of a change to that just yet. But I would say holding the 50-day is a big part of that thesis. The RSI holding 40 on that pullback is another part of that as well. At this point, this is sort of following the traditional pullback within a bull market kind of script. We break that, and that's where it just tells you it could be something more negative. Couple individual charts here to finish things off, and we'll take a couple questions. The chart of Meta featuring what I would say is a pretty decent example of a 3-candle pattern called an evening star pattern. This is what happens when you have an upward move. You have a big up day, you have a smaller day that's a bit of a gap higher, and then you have a big down day. So it's like 1, 2, 3. And there's some nuances about this that you can think about, but it's basically a 3-candle pattern suggesting reversal. I applied a couple Fibonacci retracements on here just to dig into this a little bit more deeply, to think about the price and time relationships. If you look at the February to April sell-off, you can see that first rally off of the April 7th low kind of got right back to 38.2% of the way back up, which is pretty classic. We went back and retested the low. Then on the second attempt, we gapped higher. That was on earnings at the end of April. And now we've continued higher as well. This week, we actually gapped above the 61.8% retracement level, got up to almost 665 on yesterday's session. As we rotate lower, we're right at this area of support, the previous Fibonacci level. I think we break below this. That, to me, suggests a retracement back to the 200-day or around the 38.2% retracement of the advance, which means we go down to around 590, 595 or so. So again, I think this is one of those short-term reversal candles, suggests some weakness. Seeing this on charts like Meta tell me, ooh, is that how the S&P stalls out? Names like this kind of rotating higher and then pushing lower. We'll see. By the way, as a reminder, working with Steve Nissen years ago, the way you validate this is you get follow through to the downside. The way that you invalidate this 3-candle pattern, it tells you, nope, that wasn't it. The high of day 2, right? The high of the pattern, that's the stop. So, if we break above there, that tells you, nope, the evening star was not confirmed. We're probably going higher. Cisco, nice rally, but right up to previous all-time highs. So great news on the rally, up about 5% on yesterday's earnings report. The bad news is we're getting right up to a key resistance level from February. So not the play I would usually make is after this sort of accelerated run that you just plow right above all-time highs. You'd expect at least some sort of pullback here. But again, a decisive move above 66.67 would complete the move and suggest further upside in Cisco. All right, final chart. Universal Health Services, I almost said United Healthcare. Those tickers are so similar. I always do that. UHC is United Healthcare. UHS is Universal Health Services. By the way, my kids, for some reason, this happened a couple months ago. They asked me randomly to start quizzing them on tickers of companies. And it's become a big game that we play randomly in the Keller household. Well, I've tripped them up with a couple, but they're starting to know the good one. They have a pretty good memory, so they're starting to capture all of these. Maybe I'm grooming them to be market misbehavior commentators down the road. We'll see. But it's enjoyable. Universal Health Services, they're kind of picking up on the easy ones, so I have to come up with more exotic ones to look at. I wanted to highlight this chart. I wrote an article for CNBC Pro earlier today talking about a different stock within this sector. UHS is an interesting one because it's just breaking above Fibonacci resistance this week. I'll show you what I mean, right? If we look at the last year or so, you can see the peak from September of last year. You can see the low from mid-May. Now, the S&P kind of bottomed out April 7th-ish. This stock actually made a new 52-week low a little after that, but from there has accelerated to the upside pretty well. Now, this rally has taken us right to the 200-day moving average and right to the 50% level. So I think getting above that at least suggests upside to the 61.8% level. So kind of breaking above 198, you open the door there as a short-term move. Seems pretty good. I think that's where you'd reassess it and see if it has the upside potential. But I like the trend going into this. I like the fact that the RSI is maybe pushing above 60. That following through would be pretty meaningful in my book. All right, we'll take a couple of questions here. My name is Chuck. Thanks as always for watching. You put questions in before, and I appreciate them very much. Do you pay attention to candle patterns on indexes or only closer in like stocks? So here's the thing. I do to a degree. What you have to remember, and this is probably something that comes from Dave's early days as an analyst, but the way that indexes have been are quoted has changed. And for the longest time, and I haven't gone through, and I should do some research on this before I go telling you here's what it is. But indexes would have a fixed open. So the open was yesterday's close adjusted for gaps or splits and stuff, if I remember right, capital changes. So it pretty much was like an artificial open. They've changed that. And as far as I know, it's a more a more representative open of where the markets are actually opening. But what you have to remember is the S&P is not like a set open, right? Something like IBM, there's an official exchange open. This is where trading starts, and then kind of things go from there. It's one of the few things that market makers on the floor of the New York Stock Exchange still to this day do is kind of set the open, right? In a lot of cases. And so I would say at that point, that there was meaning to the fact that we opened at a certain level and closed at a certain level. So that range made sense. Indexes I've always avoided them because of the fact that the open was not a, true market open. It was more sort of a fake open. And then once all the individual stocks started trading, the index would kind of catch up. So the good news is I tend to use ETFs more than anything because they have a proper open, just like stocks do. So I rarely talk about candle patterns on the S&P 500 index. I would talk about it the SPY. I don't have futures data on stock charts, but if I did have futures data, looking at the futures data is pretty good for looking at opens and closes and assessing candle patterns. So that's how I would think of it. But in general, for me, it's important in terms of my analysis of candle patterns to have the open and the close, right? The candle that you're looking at to have meaning. So things where that's not true, I tend to not use candle patterns as much. There's my answer. All right, maybe one more question and then we'll be done. Let's see. Yeah, Bull Bear Jeff, thanks for watching. He said IBM strong on no news. Yeah, I mean it's so funny. I mean if you think about it, it is a common issue that we've seen that I've seen for years. And what's so funny is I actually years ago got my hands on a sort of a what do you call it? Like a welcome to a news organization. I'm trying to stay away from specifics, but at a large financial media organization, I found their guide, their writing guide for authors, and literally in the guide it said you can't ever have a headline on a company or a market or anything that doesn't have a cause attributed. You cannot say IBM just went higher. IBM moved higher because there were more buyers than sellers, because there was optimism. It has to be a reason. IBM went up because of optimism about earnings. IBM went down because of fears about management change. Like even if it's made up, you have to have something, because you want to imply that we kind of understand what's happening and it all makes sense. If you talk to anyone who has spent a moment on a trading floor or at a large financial institution, they will tell you that in real life, things just move and things just happen. And sometimes there's a very clear reason where the market moves and it's obvious. There's a Trump, tweet, there's a Trump announcement. Everyone's hearing it. Everyone sees it. We all make a change. Like that definitely has happened a lot. However, there are also times when things just move, and sometimes people get nervous, they get excited, or they get optimistic or pessimistic, or they're doing a bunch of other things, and it just makes the price do a certain thing. So sometimes there's not always a reason. And I find too often we hear that so much that we always want to know the reason. Why did IBM move? What I've learned looking at technical analysis is the reasons often become really obvious down the road. So waiting for it to be clear what caused this move to happen, you're way behind the game. It's like waiting for economic data to figure out what's happening with the economy. It's much better to look at what's happening now and project what's going forward and then use that, right? And so looking at price as a way of identifying, yes, things are changing. Yes, this is important. No, this is not. I think that's a better way to do it. Folks, thanks so much for watching the show today. We're going to tighten up the time a little bit. I've gotten some feedback about the time length of the show. I'm looking at all the content I'm doing for this show, as well as other things that I'm doing for my premium members and elsewhere. And we're going to tighten this up a little bit. But hopefully this is a great rundown of market conditions here on May 15th. Thanks for all your thoughtful questions. We'll do an all mailbag episode on Friday. Have a great evening. And in the meantime, remember, it's always a good time to own good charts. Take care, folks.